what does it feel like? If I look at the opening test, you can already see the 1430 open. Now, obviously, when the 1430 opens, the opening pop was to the upside, drove through, gave you a sell initially. The sell never went anywhere. Straight away, the first thing that happened as soon as we went through the open was buyers came in. Now, obviously, we can look at the internals at that stage to try and get an early start to this narrative. I'm taking it right down into the very, very, very short term because this is how you can see the trade evolving. If I look at this and I look at some market internals, in the early stages, the market internals were straight north. Straight north. So when I'm looking at that, I'm not going to be trying to sell it. I can't sell it against a market internal that's going bullish. So when I see them trying to test the price lower twice, not just at the opening bell, but right into this second phase here, that test is to see if there's any sellers willing to be stupid enough to sell it. That's your buy trade. And the takeaway from that trade is absolutely glorious. And it takes out the RGL in the background as well, which leads to, ultimately, this very, very reasonable upside takeaway from the trade itself. And that's what we're looking for. Now, there's other reasons in the background why the opening test would be bullish. Commodity risk spread, for example, the commodity risk line was bullish. The ABCs had started to find a lot of buyers coming in on the ABCs. We started to see those types of things. The overall shape of the other markets across the spreads looking pretty solid. You know, the shape of just everything was pretty much in line at the same time. The 10s, 30s curve was bullish, starting to show us upside potential on the trade. Now, they obviously risk this. The risk was the fact that we're getting some weakness on the oil prices. And that weakness on the oil prices might have been giving you a bit of a dampener as to how this trade might evolve. And obviously, if that trade does evolve in terms of those terrible opening tests to the downside, then you just watch it. You watch for something showing up. You watch for some evidence that says this is what the trade is. Now, obviously, if you're a NASDAQ trader, what does the NASDAQ opening test drive look like? Because this is a conversation we had with Nick earlier about the NQ. Let's take a look at the opening test drive on the NASDAQ, because obviously NASDAQ, a lot more volatile. And the storyline, quite different on the NQ. So we get the open here at on the NQ here on a 5-second chart. There's the open. The first thing that happens is the same buy to the upside, and then it sells off aggressively here. So your first trade is that same short trade, and this time the buyers couldn't take the market back through that opening test. They took it down quite a bit. They found sellers actually below the bottom edge. So that's interesting, isn't it? But the drive wasn't massively impressive. So that's not convincing that that is exactly what the trade is. When they come back up, now the challenge, of course, is looking at what happens up here. This is just inside the previous swing, by the way, before the open. And then it tops out again here, and you're wondering whether this trade is going to go anywhere. And you can see the NASDAQ actually had a terrible time at the open. Look at that sell-off into that opening phase. The NASDAQ had a terrible time. And then obviously the big commercial buyers came in. Now when we look at that, we can obviously understand that the NASDAQ is getting murdered here. Remember we said about trading in the line, in the direction of this blue line, which is the NASDAQ S&P relationship, just to give us a few clues about what's happening. The 2s 5s, 2s 10s, storyline, bearish. You see that? So if there's any index that's going to go short at the open, it's going to be the NASDAQ. If there's any index that's going to go long at the open, it's going to be the S&P. So this gives you the perfect spread opportunity, doesn't it? You're going to sell NASDAQ, buy S&P at the open, if that's what you want, at the open. Is this a 5-second chart? Yes, it is. It's a 5-second chart, just so that we can get into that actual opening swing drive itself. So as an index trader, that's what I'm interested in right there, isn't it? I'm trying to find that little bit of business about whether we should be able to buy or sell into that at the early stages of that move. Now, Cliff gave you a heads up about a little indicator he uses, which is the VWAP NQ. You've obviously also got that highs lows indicator as well. So you've got those both for the NQ itself. So let's take a look. Let's pop the comparison in, and we'll do the at high dot NQ minus at low dot NQ, and we can look at what happened to the highs lows on the NQ itself. Sorry, I've typed in the wrong thing, guys. I've typed in Arlo. And there it is there. So when we look at that itself, you can already recognize the significant weakness of the market internals on the NQ from the open, can't you? See the difference? You see how weak that looks in terms of the NQ? Massively weaker at the top edges. Selling into this big move here wasn't there for a surprise. This massive volume suggests that that maybe is a bit too far because there's no additional selling coming in here. And obviously that big volume would obviously be problematic for anybody trying to sell in at that price. You're pretty much probably the bottom edges when you see that size of volume. And the buyers managed to turn the price round, and the upside has been pretty good, but you can see that there is a very large divergence between the NQ just now and the market internals, hence the reason why these big volume candles, you're going to start thinking to yourself, nope, that's a top edge sell in the NQ again up here. And obviously when you look at that against the curve, you can see the curve still supports it, but this doesn't support it just now. So you're going to be watching that and saying something's not right about this. There's going to be people that are going to buy the stocks and they're going to start selling the futures. So that overall shape suggests more of a rotational feel because the curve is obviously weak at that stage. You'd obviously start thinking about that as an overall shape. Remember, the curve is the relationship, not necessarily the chart itself. So if the curve is going in that direction, and of course there may be a situation where the NQ-ES relationship is what's wrong, and therefore selling NQ and buying the S&P might still be the better opportunity at that stage. Selling the blue line, in other words, might be the better opportunity at that stage. So big volumes, always going to be a warning about a trade setting up. Your job is to find it. And if you don't like using highs, lows, then of course you can use Cliff's suggestion, which is the VWAP. It's basically this, in most cases it's nearly always exactly the same. But it does have occasional changes. So you could do the VWAP. It's not a VWAP, it's PCT. And just choose the NQ. And you can get another view of the market internals on the NASDAQ. Now, as I said, on this occasion, it did a terrible job of finding the high price, but it did a great job of finding the low price. I want to try and put the two of these together. Now, the reason why these separate and why they go in the opposite direction in the early stages is because of where the price opens. If it's gapping up, then obviously if it's gapping up but it's not gapping up too far, nearly all the stocks will be above VWAP, but they'll all be below highs and lows. So you're going to get a difference of opinion in the early stages. What's going to happen is these two indicators will kind of normalize as the early stages start becoming normal. You'll see these two indicators starting to normalize at that stage. So I like it at the highs and the lows in the early stages simply because it gives you that early stage information about stocks that are really, really still punching, and it gives you that idea about the opening gaps more than the VWAP does. But they should normalize. They should end up roughly about the same after the first few seconds, or after the first few minutes, and we should be able to get a good read against those types of narratives up here. But you can see that the individual stock buyers, obviously a lot of people have bought stocks in here and they push the price up. And again, you can try and compare that with something like the NQ1 against the NDX. which is obviously the prem of the NASDAQ itself. So when you look at the prem of the NASDAQ, again, it's going to be a scaly looking indicator, isn't it? You're going to see this indicator kind of a little bit offset a little bit. But you can see that the futures price in this area here is massively overpriced against this very, very discounted stock. So you can obviously start to already tell that the futures are overpriced, because you can see what happens up here, can't you? So when that future starts coming out here, that's because you're starting to see bids coming back in the underlying stocks, and that's going to drive a little rotation off the top edge of the NASDAQ, isn't it? As part of a hedge trade. And that's exactly what happened. That's exactly how that trade eventually evolved. It was basically just a spread trade by the institutions. Price rotated round a little bit. Sexy? It's kind of sexy, isn't it?